Good morning to our listeners in Europe and good afternoon to our listeners in Asia and the Pacific. So our topic today for this webinar today is addresses the fears of rising inflation. The continued economic recovery and the unprecedented economic stimulus we've seen from governments has led to fears of inflation re-emerging. So in this webinar, we will show how a new series of inflation-friendly equity indices can be used to protect investors' portfolios against rising inflation. I am delighted to be joined by Dr. Felix Goltz, Director of Research at Scientific Beta, and Dimitris Korovoulis, who's our investment product specialist. They will be presenting the results of our research on this topic and how our research insights were used to build inflation-friendly equity indices. So what I would like to do to stimulate the discussion with Felix is I would like to ask Felix to address three main questions. First of all, which investors and why do investors care about inflation risk? Secondly, how do you go about trying to build an equity portfolio that is sensitive to inflation, given that inflation is a backward-looking measure that is only reported on a quarterly basis and is often revised? After all, stocks tend to react much quicker and incorporate information instantly. So how do you go about building an equity portfolio that is sensitive to inflation? And when building an equity portfolio that is sensitive to expected inflation, should the portfolio be built by allocating to sectors, overweighting and underweighting sectors, or allocating to factors? Or do you need to build the portfolio from the bottom up and identify individual stocks and their sensitivity to inflation? So those are the three questions I have just put to Felix. So I will hand over to you now, Felix, to address these questions.
Yes, thank you, Eric. And let me start with the first, which is really, why should actually investors be interested in influencing the inflation exposure, and how does that fit within their overall investment strategy? So if you think about equity investing, it's clear that investors are looking for exposure to this long-term equity premium. That's why they're holding an allocation. But they also recognize that this equity exposure also implies exposure to broader economic risks. So things like interest rates, broad recession risk, and of course inflation as one of these risk factors. And investors could simply accept, whatever inflation exposure they get from overall equity investing. So since equity gives you a claim on, the assets of a company, and so the underlying cash flows, you would actually expect to get some protection from equity. If there's, very strong inflation that would devalue nominal bonds, you don't have this problem with equity, so you would expect some protection. However, investors typically, will not target a level of protection. They will simply accept whatever package they get with a broad cap-weighted index. They may, however, benefit from, trying to really design the equity portfolio more carefully, and this could allow them to target such exposures. So there's two reasons why investors would like to target inflation exposure. The first one is quite simply that they may have a view. Okay, so maybe, currently there's lots of talk about reflation, and there could be an investor who has the view that that's wrong, that's not going to happen, and so you could actually express that view by holding an equity portfolio that will hold stocks that will actually do relatively well when inflation is actually lower than expected, or you can have the opposite. You also have investors that do not have a view, but that are heavily affected by changes in inflation, for example, because of their outside income. So they may or the outside liabilities of assets that are not directly in the equity portfolio. So they may already be affected by inflation shock. So they may want to protect themselves against this. A typical example would be a pension fund that has liabilities linked to inflation. And so if there's a positive shock on inflation, that fund would actually be in a bad position. So you may want to protect against that. These are the two key motivations. Now, you have to distinguish between a performance-seeking motive and a hedging motive when you look at investors' overall allocation. This is a famous fund separation theorem of Merton. So investors will have a performance-seeking portfolio if they do not have any particular hedging demands. That's all they're going to hold. But then if they also have hedging demands for some macroeconomic state variables, they will actually use this hedging portfolio to precisely hedge out these state variables. So what you're going to do on inflation is going to be very different whether you're in the performance-seeking portfolio or whether you're in a hedging portfolio. So of course you can decide to have a dedicated hedge for inflation. That's obviously not going to be based on equity. That could be based, for example, on inflation-linked bonds. That could be based on inflation swaps. So these kind of instruments give you a very reliable, very direct offset to any realized inflation. The problem, of course, is that you have high opportunity costs. You have to pay for hedges. In the performance-seeking portfolio, there's also something that you can do about inflation. So you're not going to look for a perfect hedge, completely offset inflation, but you have to recognize that there are different candidates for this performance-seeking portfolio. There's probably different portfolios that you can choose. You may not really be able to distinguish between, say, the Sharpe ratio that you get from different candidate portfolios. So among all of those portfolios, you might as well choose a portfolio that has some protection against relevant state variables, say inflation. And here you have different candidates you could think about. So a lot of investors are interested in things like commodities or REITs or even just broad equities. But these asset classes are understood to provide some protection against inflation. They may go a step further and they may try to use dedicated strategies. So within equities, maybe there's something that you can do to actually vote on stocks that provide more protection from inflation than the average stock. So what we're looking at here is precisely this idea: an investor who is exposed, let's say, to liabilities to inflation shocks. What can he do in his PSP, in the performance-seeking portfolio, to actually design an equity building block that will have some protection from inflation? So this is exactly what we're going to look at. Why is it interesting to look at equities? Well, investors can look at different asset classes. So commodities is a popular candidate for inflation protection. The key problem with commodities is that there isn't any evidence or any economic reason to think that there should be a long-term premium if you just long only in commodities, and so they're not good candidates for that reason for the performance-seeking portfolio. But they may hedge inflation, or they may protect to some degree against inflation, especially if that is related to raw material prices and increases that drive inflation. But there's really the problem with commodities is that you expect premium. For equities, you get access to the equity premium, and of course, equities are also able to protect against inflation, and especially things like wage inflation. It would be difficult to see how commodities provide protection, but equities could provide protection more generally against inflation. So what we have to do when we design a dedicated equity portfolio is really figure out how different stocks react to inflation, and we can exploit these differences. Now, that seems a sensible idea. However, it's important to note that measuring which stocks will protect more against inflation is actually really difficult. And there's actually a lot of research results that suggest that trying to identify stocks based on how well they protect against inflation is a completely futile exercise because it is so difficult to measure. So there's a paper by Andrew Ang and Brian Signori in Financial Analyst Journal where they show that when you try to measure how well a stock protects against realized inflation, and then you build a portfolio that that is going to use these stocks, well, going forward, after you've assembled the portfolio, there isn't actually any difference in inflation protection, whether you use the highly protected stocks or the low protected stocks. And this is simply because it is so difficult to measure reliably which stocks protect against inflation. And that problem arises simply because inflation is quite a backward-looking economic fundamental. So as Eric mentioned, this is typically quite low-frequency data, it's subject to revisions, etc. So we would expect that stock prices react much faster than the release of these fundamentals. And this is a very general point about economic fundamentals and stock returns. And so asset prices just move too fast to be able to detect a link with these slow-moving variables. So there's some challenges. We have worked on a methodology to overcome these challenges, and so I'll just explain the key ingredients of that methodology. So we have confirmed these earlier findings. It is actually difficult to measure exposure to inflation reliably, but there are several steps that we take to come up with a successful measure of inflation sensitivity. And there are three ingredients to that. The first one is really to look at something other than these backward-looking economic fundamentals. So you have to use forward-looking variables, and I'll explain that in more detail. The second important aspect is, even with forward-looking variables, well, you can actually do a bad job on measuring the exposures. So you have to think quite carefully about robust statistics to measure these inflation betas, or this sensitivity to inflation. And a final step, going to this question, third question from Eric about, well, can we do this with sectors and factors, or do we need dedicated portfolios? Our research also shows that simply allocating across standard building blocks like industries, for example, is not going to lead to successfully capturing inflation protection of properties of different stocks. You actually do have to go to the individual stock level and use really the information that you have at the firm level, and I'll just show that in a while. So let me just explain in more detail the approach that we have implemented. And so the first important step is really using these fast moving variables, these forward-looking variables. And in particular, what we are using is we're using the inflation surprises. Okay, so we're trying to identify stocks that actually protect against unexpected changes in inflation. So that is important for a simple reason. If you look at the level of inflation today, and you're trying to figure out how, which stocks do well when the level of inflation is high, well, you're not actually going to get any answer, because stock returns do not react to the level of inflation. Right? So stock returns will actually, or stock prices will price in the level of inflation that is expected, and it is only the component that has not already been anticipated that will actually show up in movements of stock prices. So it's really when new information arrives that stock prices adjust. And so we can only try to find a link with what we call the surprises, so basically the unexpected shocks to inflation. And so that is really the relevant variable for investors, and it's the relevant variable for detecting and measuring which stocks we have to use. So we're going to use a measure of inflation surprises. Let me be more specific. What we're using is the break-even inflation from inflation-linked bonds. Okay, so we're looking at the break-even inflation at a 10-year horizon as extracted from inflation-protected bond yields compared to nominal bond yields. So these yield differences reflect expectations about inflation. So the good thing about this is that we are no longer, stuck with these very backward-looking measures. We're not looking at release of inflation data from, the Bureau of Statistics. Instead, we're looking at investment expectations as they can be extracted from bond markets. So this reflects expectations. Then, of course, we have to use the surprises in these expectations as opposed to the level of what is expected. So we are actually using the unexpected changes. So this can be done formally by building a vector autoregressive model that gives you the, let's say, the average expected value that you would expect based on the past dynamics of macro variables. But you can also simply use the change or the difference in break-even inflation from one period to the next. In our setting, actually both approaches, the simple approach and the more sophisticated model, actually lead to almost identical results. So we're really interested in these surprises, in these fast-moving variables. That's the key difference with a lot of the literature that has shown that you just cannot measure exposure to inflation. Once you have these highly reactive surprises, then you would actually expect that stock returns are linked to these kind of surprises. But you still have to measure things reliably, especially when you go to the stock level. You're still likely to pick up a lot of noise, right? Because you're trying to figure out at the level of each individual stock what is its inflation sensitivity, and so we still expect that there's lots of noise in that in the data. So we're going to actually use different steps to make sure that the measurement is controlled. So the first step is we're going to control our market exposure of the stock, and this is simply because what we want to do is we really do not want to change the active to the market premium. So we're only interested in the difference that stock shows relative to the overall market. A second important aspect is we want to have precise estimates of sensitivity, and to get this precision, we're going to use a fairly high frequency, so there's going to be a weekly frequency of returns observation to actually measure these sensitivities. It's quite surprising, but quite often when people measure sensitivities, they're going to work with monthly or quarterly data, and obviously this gives you a fairly low number of observations and is not likely to lead to accuracy. So we improve accuracy by having these weekly frequencies. We also account for the time variation in exposure. There's no reason to believe that stock sensitivity to inflation is going to be. So we're using a weighted least squares approach to actually account for the time variation. So the intuition is that we're basically going to overweight recent observations and underweight observations that have further in the past, while actually using all of the information that we have in a very long sample of returns and inflation shocks. Now, this gives us some fairly decent estimates of stock level exposures. However, we have to recognize also that these estimates are measured with uncertainty, and the level of uncertainty is not going to be the same across two different stocks. Right? So if we have two stocks with the same inflation sensitivity, and we know that that sensitivity is measured with a high level of uncertainty for one stock, but is actually measured with a very low uncertainty for another stock, we obviously want to favor the stock with low uncertainty. So we're also accounting for estimation risk, so we're adjusting our estimates for the uncertainty that we need to estimate. So these are the key principles. For reasons of transparency, so we're also showing a slide that actually notes down the methodology. But this is just what I explained previously. So we're basically estimating this macro beta, which is the sensitivity to the surprise, and then we're going to actually account for uncertainty using the Bayesian shrinkage approach. So final, not the one that we get directly from the data, but we're actually going to have the Bayesian shrinkage where we take an average of the estimated value and prior value, it's the overall average, and there will be more weight on the estimate when there's less uncertainty and more weight on the prior when there's more. So that will give us a decent statistical estimate. But we're still only looking at returns information, right? So we could think that there could be much richer information on which stocks are very sensitive to inflation, and we're trying to use an additional data source. So we're trying to exploit textual data. There is a section in a firm's annual reports in the US, which is called the risk factors section. So that's part of the annual filings of this Form 10K with the securities regulator. And so this is publicly available data. You get a description of what are the key risk factors of the firm's business. And firms here really try to disclose what are really the important factors that would influence their profitability and their business. And so what we're doing is we're just reading these risk factor sections of the annual reports, and we're extracting a measure of inflation sensitivity. So we're just looking for inflation as a keyword, and what we're computing is the percentage of that risk factors section that is actually made up by the word inflation. So if a company, mentions inflation a lot, it is likely that it's worried about inflation. If the company never mentions inflation in the risk factors section, it's probably unlikely that this is something that influences the stock price to a large extent. So then we're just going to complement our statistical measure with this textual information. And again, the idea is just to use more information than what we have in the returns, in the past returns. So this is the key methodology that we're using. Let me just show you the result of this measurement approach. So what I will show you is results for long short portfolios. So we're going to go long the high exposure stock and short the low exposure stock, and this is an out of sample analysis. So we're going to construct portfolios based on the macro sensitivities that we measure. Then we're going to hold the portfolios. And all this analysis is about, well, how sensitive are these portfolios to inflation after they've been constructed? Okay, so this is an out of sample analysis, and we'll show that, unlike some previous papers that documented failure of, measuring this exposure reliably out of sample, we will actually show that with these ingredients, we can actually measure this exposure reliably. And so here's a first view on the importance of the forward-looking variables. We just construct the portfolio using break-even inflation, and out of sample, we actually do get a positive exposure to inflation. That's what, by design we would expect. That exposure, however, is not statistically significant. It's still an improvement over using backward-looking variables. So if you use the backward-looking inflation index, you would actually get a realized exposure which is very close to zero. It's not even 10% of the magnitude of what we get with the forward-looking variable. And this is also true for other backward-looking variables. So if you looked at things like industrial production, you're basically going to get realized exposure which is close to zero. And that's exactly this problem that others have documented. So using this forward-looking variable, it seems to bring us already one step towards an improvement, but still this is not a conclusive result. So let's see what happens when we also use our robust measurement. So what I've shown so far was really we measure exposure to break-even inflation surprises using this naive measurement. Okay, so naive measurement, we just run a simple ordinary regression, using monthly data as is done quite commonly. So that gave us this exposure of about 2.5, not significant. If we use our robust measurement approach, we end up with an exposure of 4. so almost double in magnitude, and this is significant statistically. So this confirms that you can actually capture these exposures reliably if you're doing all these improvements to measurement that we discussed. Just for comparison, we also conducted the analysis using the levels of break-even inflation. So it's quite clear conceptually that it's not sensible to try to measure exposure of stock returns to a level in a macro variable. And the results here confirm this. So even with our robust measurement approach, when we use levels instead of surprises, we completely fail to actually get any reliable out-of-sample exposure. So the measurement approach is really quite important. And so I addressed these two aspects of our measurement. So we're using these forward-looking variables and we're using robust statistics. So far, I haven't addressed this question from Eric on, okay, can you just do this with sectors and do you really need to break things down at the stock level? So here you have results showing how important it is to really go to the individual stock level. We're looking at this macro dedicated portfolio. So we're just looking at a portfolio that selects stocks based on positive exposure and another one that selects stocks based on negative exposure. And when you do this at the stock level, you do get this very pronounced difference in macro exposure, right? So there's a positive exposure in the exposure plus portfolio, and there's a negative exposure in the exposure minus portfolio. That's exactly how the portfolios were designed. So this works out very nicely, as we've seen before. Now we did the same kind of analysis, but using equity factors to get high and low inflation exposure. And you can see that these allocation to equity factor, completely fails. You do not actually get the expected difference in exposure. Actually, the factor allocation that was looking to get negative inflation exposure gets positive exposure, and that's actually higher than what you get in the portfolio that targets positive exposure. So that seems like a nonsensical result. Where does this result come from? Well, it just comes from the fact that equity factors were never meant to measure differences in exposure to inflation. So there will be some differences when you look at equity factors. And what we do here is we use our same measurement approach and we select the high exposure factors, and we're going to then short the low exposure factors. We're going to select them in the allocation minus. And the problem with this is that you may pick up exposures and differences in exposures that are relatively small, and so you're going to overweight factors that are more positively exposed to inflation, but the difference is not that pronounced with other factors. And given the measurement error, you're basically in the end just loading up on a lot of noise or on very small differences, which may not be significant. We have the same result for sector allocation. So looking at sectors, you're going to make some allocation decisions, but you do not actually get the desired exposure. So why do we get this result? Well, simply there's no good reason to think that differences in inflation exposure will be entirely explained by factors, by sectors. So even within a given sector, there can be very pronounced differences in inflation exposure. Okay, if you look at a sector like materials, for example, or financials, yes, this sector will be exposed differently to inflation from the average stock market, but also within the sector, stocks will look very different. And just having these allocation approaches just fails to capture these differences, and it's actually important to do so. So three important aspects really of being able to really target efficiently and out of sample a given level of inflation. Now we've used this methodology to design dedicated indices that allow investors to pursue these targets. And I'll hand back to Eric and Dimitris for the next part.
Thank you very much, Felix. You've raised a number of very interesting points, which I would like to summarize. But before I summarize, I would just like to point out that we do have a Q&A box. So if you do want to ask Felix and the next presenter any questions, please type them into our Q&A box, and we will. I'll try to address those questions to both Felix and Dimitris at the end of the presentation. Okay, so you've raised a number of very important points. So firstly, when I asked about, well, which investors care about inflation risk, some investors who care about inflation risk may, or be concerned about inflation risk, may actually take a tactical bet by trying to get exposure to stocks that are more sensitive to inflation. So it can be used in a tactical way. But you also mentioned that it can also be used in, if you like, a strategic way. Institutional investors who want to protect their portfolio from inflation risks would typically do that using the hedging part of their portfolio, but using a perfect hedge like TIPS in a low rate environment also presents a very high opportunity cost. So this is what motivated the study in terms of trying to build performance-seeking portfolios, equity performance-seeking portfolios that are more inflation friendly. So that really addressed which investors care about inflation. You also mentioned that in terms of measuring inflation, and in particular expected inflation instead of backward-looking inflation, you look at the difference in yield between inflation-protected securities and nominal bonds. And that data actually reflects expectations about inflation. And furthermore, this data is available at a much more frequent, a higher frequency than the typically backward reported quarterly inflation data. So you use that as a proxy for expected inflation. And then also, I think, secondly, it isn't just the level of inflation that is important, but in fact, equities react to inflation surprises. So it's the difference in levels that are important in terms of how equities react to inflation. And then lastly, you also showed us how you can build an equity portfolio that is sensitive to inflation. And what is important is that you need to identify individual securities that are sensitive to unexpected inflation, and not just try to allocate to sectors or to factors. Those kind of approaches, even though they may work a little bit, are clearly much less effective than trying to identify the stocks that are sensitive to inflation shocks. So I think the recommendation there is quite clear, is you need to go down to stock level to try to build your equity portfolio. And lastly, of course, you presented some statistical techniques which can be used to come up with a more robust measure of a stock sensitivity to inflation surprises after controlling for the market factor. So if you like, the performance relative to the market. And also what I thought was very interesting is you don't just use robust statistical techniques, you complement those techniques as well using text-based measures from the 10K files as well. So those were the main takeaways from Felix's presentation. So now let's turn to inflation-friendly equity indices, and let's turn to Dimitri's presentation. So the idea here is now to build inflation-friendly equity indices. And there's also, of course, no reason why we can't build exactly the opposite type of index, an index that benefits from a deflationary shock or a negative inflation shock as well. So I think Dimitris is going to look at both of these strategies that do well when we have a positive inflation shock, and strategies that do well when we have a negative inflation shock. Now, to just introduce Dimitri's presentation, again, I have some questions to motivate the slides that Dimitris will be presenting. And the first question is, what are the short-term and long-term objectives of inflation-friendly equity indices? What is it you're trying to achieve in terms of long-term performance and in terms of short-term performance? And given the design of these indices, how have these indices actually performed out of sample to inflation surprises, and in particular in relative terms, in terms of relative performance to the market? So that's the first question for Dimitris. The second one is, are inflation and deflation sensitive indices also exposed to any other factors in a meaningful way? So that's question number 2. And question number 3 for Dimitris is, how do these inflation-friendly equity indices compare to other asset classes in terms of providing some protection in terms and also in terms of long-term performance? So with those 3 questions, I will hand over to Dimitri now. And as I said, please ask questions using the Q&A box, and then I will address these to the presenters after Dimitris is finished. So thank you, and with that, I'll pass over to Dimitris.
Thank you, Eric. Yes, so I'll try to cover your questions in the next few slides while I describe these inflation-friendly indices. So what we have seen so far from Felix, we've seen a robust methodology. We've seen a framework on how to identify stocks that have the desired macroeconomic exposure, and in this case, the desired inflation exposure. And we've seen that is important to. We've seen that we can create dedicated portfolios that offer this desired exposure reliably out of sample. So the natural step is to turn this framework into investable indices, and this is what we are presenting now in these slides. Investors can use our inflation plus and inflation minus indices, which probably from the name everyone already understands that the inflation plus index is the one that will that will aim to perform better in scenarios where inflation rises unexpectedly, and vice versa, the inflation minus index is designed to react positively in scenarios where inflation will fall unexpectedly. And to answer your first question, the objectives of this index can be summarized in 3 points. Basically, we want these indices to be market-like indices in the sense that they will have features that investors like and desire, such as high investability and high liquidity, similar to the cap-weighted benchmark. So that's objective number 1. And objective number 2, regarding the long-term performance of these indices, we'd like them again to be market-like in the sense that they will offer the long-term equity risk premium similar to the cap-weighted benchmark, which means, in other words, that these indices are not trying to find an additional risk premium and offer some long-term outperformance of the cap-weighted benchmark in the sense of gaining some additional risk premium. Objective number 3 instead is that these indices will offer the desired conditionality with inflation. That's the shorter term objective for the performance of these indices. So they will try to, under a reasonable tracking error, so that objective 1 and 2 is maintained, they will aim to offer the desired conditionality to inflation. Now, how to achieve this? The natural way to design this index is to use a sort of a tilt approach. So here we summarize the methodology for designing the indices. The idea is to use a score that describes the exposure to inflation, and using this score to tilt the weights of each stock around their market cap weight. The stronger the exposure, the stronger the tilt will be around the market cap weight. And at the same time, we have some constraints that will allow us to retain the high liquidity and investability of the indices and respect a general objective of moderate to low tracking error. So we aim for weights not to be extremely different, or in the extreme scenarios to be super high compared to the cap-weighted weights. So what is interesting to notice is whether these investable indices actually do the job, if they actually measure the inflation exposure reliably out of sample. So in this table, we see that indeed the inflation plus index has the positive sensitivity to inflation, and it's statistically significant. And vice versa, the inflation minus has the opposite sign, and this table confirms that these indices indeed out of sample have the desired sensitivity to inflation shocks. The next step is to see how these indices actually perform during the different scenarios, how they perform when there is a positive inflation surprise and how they perform when there is a negative inflation surprise. So in the next few slides, we will see this result from different angles. The first angle is to see the long-term picture. The long-term picture here shows you over the gray area, you have positive inflation surprises, and you can see that the blue line, which is the inflation plus index, more or less reacts positively in its performance when you have this positive inflation surprise. And vice versa for the red line, the inflation minus index, it will react negatively when there is a positive surprise. Or if you want to look at it from the other way around, over the white area, when inflation drops, this index will tend to perform well. So this is the long-term picture. And if we try to summarize these numbers and see an annualized long-term average of these numbers, we can see that the inflation plus index on the blue box, it performs strongly relative to the cap-weighted index by 8% when there is a positive inflation surprise. Similarly, it will perform negatively when there is a negative inflation surprise. And the inflation minus index will have, again, the desired conditionality, will have the opposite picture. It will perform positively, relatively positive by 5% when there is a negative inflation surprise. So this is interesting. It shows us that the index has the desired conditionality and it performs as expected. We can see the same numbers in a more granular level. At the bottom side part of the table, you can see this relative performance to cap weighted. You can see the same numbers in the rows negative inflation surprise and in the row positive inflation surprise. And if you take these differences, you can see that the macro spread is strong and is in the direction that we expected. You have a plus 13 macro spread for the inflation plus index and a minus 11% for the inflation minus index, which if you look at it from the other way around, if you're concerned about deflation, then you have the strong positive macro spread on the direction that you like with these indices. Now, in addition to the long-term numbers, it's interesting to see what has happened recently, where a lot of investors are discussing the topic in the beginning of this year. Actually, we've seen in the data that there is a lot of periods with positive inflation surprises. Again, this is the gray area. And we see that the inflation plus index has performed quite strongly since the beginning of the year. just because it can capture reliably these periods. And we can see also the same numbers here in a table. We can see that the inflation plus index has a relative return of around 3% for the year, and the inflation minus index has a relative return of minus 1.8 roughly for the year, exactly because of the scenarios of the period we observed, which had a lot of inflation positive surprises. If you look only during these periods, during the positive inflation surprises, the inflation plus index had a very strong plus 4.8 relative return, which shows that is exactly doing what is expected of the index, trying to react positively when you have these inflation surprises in the market. Now, some more statistics over the long term to give a sense to the audience about how these indices achieve their long-term objective, which is to be similar to the cap-weighted benchmark. You can see that for both indices, the relative returns are moderate and low or low, plus 1% for the inflation plus index, minus 1% for the inflation minus index, which shows you that over the longer term, these indices will behave similar to the cap-weighted benchmark. Similarly, the tracking error is moderate, around 2.5%, which is enough, which is what you need to get the desired conditionality that we observed in the previous slides. So these indices are performing as expected or in line with their objectives, their long-term objectives and their shorter-term objectives. And I think here we can answer also one of Eric's questions on how these indices square out with respect to factor sensitivity. We can confirm here that the indices are again similar to a cap-weighted benchmark in the sense that the market beta is around 1.04 for the inflation plus, 0.96 for the inflation minus. So there is a confirmation of their cap-weighted anchor. And then there is factor betas that are small, that are low, and do not give you a particular factor sensitivity when you target this inflation exposure. So for cap-weighted investors, they can reliably choose these indices according to their view of inflation worry or deflation worry, and use them as a substitute for cap-weighted index. Or similarly, for multi-factor investors that hold a multi-factor portfolio, they can use a long-short or overlay version of these indices to overlay their multi-factor portfolio without the fear that this exposure will alter significantly their factor objectives, while it will give them the desired inflation sensitivity. So with this in mind, it's interesting also to check what happens what happens to our indices with respect, what happens to other asset classes and how they square out with our indices when it comes to inflation sensitivity. Because there is many investors that are turning usually to asset classes like commodities or real estate, or they even try to do some sector or factor tilt to give them some inflation protection. And we like to check in our data and under our framework how these asset classes perform and how they square out with respect to our index. So I will start with commodities and REITs. So what happens here is that these two asset classes indeed have a positive performance during positive inflation surprises. We can see the plus 71 for commodities, we can see the plus 55 for each. But when you compare these numbers with the market returns, you can see that they are lagging behind. So you will get negative relative returns. Instead, with the inflation plus index, you can get this sensitivity to inflation surprises, and then your relative returns are much more balanced with respect to your objective. Relative returns are positive when there is an inflation surprise upwards, and negative returns are negative when the inflation surprise is in the wrong direction from the one that you were expecting, as it is natural. And at the same time, it's worth looking how these asset classes or alternatives will perform over the long term. So over the long term, again, compared to the inflation plus index, you can see that commodities have actually, they don't have a positive risk premium, so you don't expect any positive returns over the longer term. And REITs, similarly, they have different volatility, they lack diversification, so they don't match the performance of the broad market. Whereas with the inflation plus index, you can get a market-like long-term characteristics with a reasonable tracking error and the desired conditionality that we observed in the previous page. So this is with respect to commodities and real estate. And in the next two slides, we will see some result with respect to particular sectors or factors. We test a usual recommendation that investors should turn to sectors like the financial sector or to small cap stocks in case of an inflation rise. So we try to check what happens with respect to these investments. So again, the first result, and we are happy, and we see, and we can confirm this thought that investors share between themselves. We can confirm it under our data and under our framework. We can see that the financials and the small caps indeed have a positive reaction, a positive relative return in case of inflation surprises. So they can give you this protection in these periods. But what is interesting on top of this result is to move to the longer term behavior of these indices. And obviously there you start to see that you cannot reliably or easily switch your market exposure, your cap-weighted exposure with a particular sector. So if you want to have the sensitivity to inflation, the financial sector can give it to you, but at the same time, you take on some very specific risk, which here is materialized in these numbers through much lower risk-adjusted returns and a very high tracking error. And whereas the point is with the inflation plus index, you can have the desired conditionality, but you can also have an index that is similar to the market in the long term, and you can easily move your investments to such an index without losing all the benefits of the broad market exposure. So at this point, I will try to summarize the main points before I turn to Eric. So in this presentation, we showed our inflation plus and inflation minus indices, which have market-like characteristics, but at the same time give you the desired conditionality to inflation. And this is something that many investors are worried at the moment, so they can use these indices to have the right sensitivity based on their views or particularities of their portfolio. Now, it's common discussion that equities can be used as an inflation hedge, but here we presented today that the inflation plus index can give you these strong excess returns in periods of high inflation on top of being a market-like index. Similarly, these indices can be useful in a more multi-asset portfolio context, or for investors that hold bond portfolios. These portfolios are usually quoted in nominal terms, and they will suffer in case of higher inflation. Or if people are using tips, these are quite expensive, and therefore an exposure to an index like the one we described today can give them long-term performance and the protection they desire in the particular period. So we consider these indices as a good replacement for the cap-weighted index, or additionally for multi-factor investors, they can use an overlay version of these indices to protect against to protect themselves against inflation shocks. And at this point, I can turn back to Eric.
Thank you very much, Dimitris. I think that was an excellent presentation. Probably not too much to summarize here. The main points, I think you made it very clear that our inflation plus indices tend to outperform, and the outperformance was quite significant, 8% on an annualized basis during positive inflation shocks, and the inflation minus indices outperform during negative inflation surprises. However, both of these indices basically deliver the long-term expected market risk premium with a tracking error of around 4%. And you also mentioned that the inflation plus and inflation minus indices provide better protection from inflation compared to other asset classes such as commodities and REITs, and furthermore, they also provide access to the equity market risk premium. And finally, you showed that both the financial stocks and small cap stocks offer some protection against inflation. However, this leads to very concentrated sources of risk that investors may wish to avoid. So with that, we do have time for just one or maybe two questions that have appeared. And the first question is, perhaps this is probably more directed towards Felix, is would it make sense to somehow compare the performance of the mimicking portfolio you constructed to the performance of a long tips, short nominal bonds portfolio? So I hand back to Felix here. I guess this has got something to do with protection and hedging. Felix, are you able to take this question?
Yeah, sure. Thank you for the question. So yeah, I think this is a good suggestion. So currently what we've done is basic things. So we are going to check the kind of dependency of that mimicking portfolio, so that it's selected stocks based on the measured exposures out of sample. And we actually compared it to innovations in the break-even inflation, which is just a yield spread between tips and nominal bonds. And we're doing that two ways. So we're doing that by measuring innovations as the first difference. So this is quite a simple and robust measure. The advantage is we don't have to estimate any additional parameters. We're also doing this with innovations from a vector autoregression, where in the vector autoregression we include other macro variables such as the short interest rate, the term spread, the credit spread, and doing it these two ways leads to quite similar results. Now looking at the return differences between tips and nominal bonds would be an additional way, which makes sense. So that's a good suggestion. That's something we could use as an additional measure.
Okay, thank you for that. We have time for just one more quick question. Perhaps this is addressed more at Dimitris. It's about performance. And the question is, intuitively, I would have expected the inflation plus index to underperform on average because it provides protection against inflation risk. Therefore, is the outperformance that you observed during 2008 to 2021 due to a historically high number of inflation surprises? Dimitris, are you able to take that question?
Yes, absolutely, no problem. Yes, as we described in the presentation, one of the objectives of this index is over the long term to be similar to the cap-weighted index. And when we looked at the long-term average numbers, yes, indeed, the inflation plus index has an outperformance, and the inflation minus had an underperformance of roughly 1% on average. These numbers, and based on the statistical significance, we consider them low and weak. So, in the sense that yes, it could be because of the particularities of the period. So, over the longer term, you don't expect either of the indices to have a strong overperformance, outperformance for the cap-weighted index. So yes, it can be from the particularities of the period, and you don't expect over the very long term to have any particular discrepancies relative to the cap-weighted benchmark. What you expect is during surprises periods, that's when you want the conditionality, that's where you want the index to react positively or negatively depending on the side of the surprise.
Okay, thank you very much for that. And I am wary that we're just running out of time. So I would just like to conclude this webinar by saying the inflation plus and inflation minus indices are now live. They're available on our website and they are investable. Our clients can look at the performance of these indices and get to understand them better through our website. With that, I will conclude the presentation, and if there are any further questions, they can be answered through an email. The email address is webinar@scientificbeta.com. So I'll just repeat that, it's webinar@scientificbeta.com. And with that, that concludes our presentation, and thank you very much for attending.